Peter Forbes, who's joining us. Great timing. He's a data scientist at Arbor Research, and you've got a bunch of charts here for us. Give me the top line takeaway, though, first, Peter. Is the housing market going to be able to keep recovering even if rates start to turn upwards?
Well, good morning, Oliver, and thanks for having me on. And yes, I think that this trend in the housing market does absolutely have legs. We think that there are a lot of reasons to be optimistic about U.S. residential housing going into 2020.
All right, home builders this morning are up. The home builder stocks have been a great return for investors kind of betting on the U.S. stability. When we go through the housing stuff here, what's the most important one we start with? Just the degree of recovery and the strength of the new home sales?
Well, I think it would be the persistence, especially when you look at something like building permits, which came out last week with 6 consecutive months. That's the best streak we've seen in some time, and that's an early leading indicator that we really like in a lot of our modeling efforts. And that's a signal that we trust going forward, that this is something that can be sustained.
Yeah. Okay. So the juggernaut of the U.S. rebound in the economy is the way you put it. If we look at housing leading the improvements in U.S. economic data, it looks convincing to a certain degree. What does it tell us in the past? Should this be an indicator that things overall are going to get better?
I think that is, and I think that, the strength in housing is really one of the biggest arguments against the idea that we're going to have a recession sometime in the near future. That is just something that this is a particular sector of the economy where that momentum tends to be self-sustaining. And we tend to see, and we've seen housing actually begin to lead some other economic indicators, especially, on the survey side. And that's one of the reasons that we like to trust things like Google search trends and sort of get around those economic surveys that we think aren't as good as predicting economic activity as they used to be. So we really like this momentum in housing, and we think that there are a lot of reasons underneath the hood that suggest that this will keep motoring.
We were just looking at the chart there of the economic strength indexes for housing versus retail, PMI, some of the industrial figures as well. Is the breakout, though, in housing here particularly strong given rates? Is the rate story so important to housing that its leading nature may be limited?
I don't think so. And just to clarify what we're looking here, what we call economic strength indices, this is really sort of a measure of economic momentum that we use. And so we're looking at economic data as it comes in and measuring that against one-year averages. So what we have here is housing outperforming its one-year average by the most significant margin that we've seen since at least 2015. But we also see strength in retail. And what we find is that this type of, exactly as you're alluding to, this type of activity in housing should begin to pull and should be evidence of continued consumer spending pulling that positive direction.
If we go next to single-family building permits, for 6 months, this is a trend that has looked very solid. The latest apps number looked pretty decent too. But there's a little bit of tension here in the trend though, right? Because some of the search interest in mortgages and refinancing has slowed.
Yes, and that's a trend that we've seen as sort of, national average mortgage rates have held near their lows, but not yet made new lows. So we're seeing some of that wave of interest of refinancing from that break lower in mortgage rates begin to taper out, and we do expect that that will continue. But you can see the effect that it had here as we look at the last several months of building permits. There's no question that that drop in mortgage rates to what, has several year low is definitely adding some high-powered fuel to home sales and to continued construction, especially in that single-family area, which is one that's going to have strong ties to GDP growth and, of course, supports the idea of a strong consumer.
So as we talk here, I want to just pull up also the search interest in mortgages and refinancing because we see the way that's tapered off a bit since August, but is still much higher than the previous 4 years past. So I imagine that's pretty important to keep in mind too, that maybe our trend has slowed here, but there's still very robust figures on an absolute basis.
Yes, and so what we're showing here in this chart, this is looking at, this is monthly search interest over the last 5 years in both mortgage loans and refinancing, and the average across the top 50 U.S. metros. So we like to look for consistency and the way that these things vary across the country. So in addition to doing top-level nationwide analysis, we also try and drill down into these metro areas. But the idea behind this chart here is that this is somewhat challenging time to be trying to get a read on the housing market because of the seasonal slowness that approaches with winter. But what's important to realize is that we're starting that slowing from a very high level. You can see the orange bars for 2019 reflecting this very high interest in consumers going out and getting new loans and also refinancing their existing mortgages. Even though we are only partway through the month of November, we're on par for basically even search interest versus October. We think that sets us up for continued strength going into year end and early 2020 for these housing indicators.
Interesting. So this is, I think, a fascinating point, which is, okay, what do we get in this space if the Fed is indeed done and rates start to move against the mortgage buyer a little bit? So to me, then it sounds like, Peter, the determining factor for that is going to be whether or not the economy has true strength to lift things like wages and possibly employment continually, right? So that people can then afford those new homes.
Yeah, absolutely. And that gets to the heart of it. And I think that there are some interesting stories when you start to look at the divide across cities. Some of the more tech-heavy metros versus some of the old manufacturing towns, you can see some of those strains where wage gains just aren't coming through. And that comes through into the new home sales data, into the actual rental side of the housing market as well. But there's no question that even if the Fed isn't going to keep lowering rates, we assume the Fed is done. We have other reasons to believe that yield, just based on what's happening with the global growth cycle, yields could creep higher a bit from here. We're still looking at mortgage rates that are near multi-year lows, stimulative for the housing market. There's a lot of signs that suggest that this should continue to have momentum into 2020.
To come back to the yields conversation, we talked with your colleague Ben Breitholtz quite a bit about this and your guys' view that the data right now points towards higher yields. This becomes an interesting situation then, because if we've gotten these higher yields since September based on stabilization and more just kind of a positioning unwind than real economic acceleration, then that could become a little bit of a problem for housing if yields are moving upwards without big economic growth.
It's true, and I think that there is the potential for both a reduction in overall uncertainty, especially about trade, but that flows through into growth. But also if we do see, and we do expect economic momentum both here in the US and in other key parts of the world, especially in Asia, to continue to improve, that does tend to put upward pressure on sovereign yields around the globe, but particularly for treasuries. Of course, there are a lot of slower moving pieces of the puzzle, and those start to come into play. Especially as we start to creep north of 2.25 on the 10-year, we really think that you will struggle to see yields creep above 2.5%. So that long-term pressure on yield, things like demographics, old age dependency ratios, a lot of the work that Ben has done some really neat stuff with, those are likely to keep a lid on rates. So yes, we do see a situation where sovereign yields head higher, but no, we don't think that's necessarily a threat. And we would continue to lean on, as you said, the strength in the consumer, the strength in the job market, and then look for wage gains to see just how much of that is going to flow through into continued strength.
Yeah, really good stuff to connect all your guys' research together. The last chart I want to look at is a little bit more pertinent to some of the stock investors who have been buying home builders, but also seeing some resurgent strength in some of the worst performing names of this market, the likes of Masco or Ameritrade. But this is the home improvement buzz, you call it. And I think this is such a cool chart because you can kind of see the process of buying a home, moving into it by what people search and where the ticks up are. Because home furnishing has been ticking upwards while some of the home financing and real estate listings are plateauing a little bit.
That's right, and this is an interesting chart. So what we're showing here, we look at search activity across the US in all of these different categories. And when I say categories, we use Google's curated lists of related terms, so we can kind of see a general idea of these types of broad searches, types of materials, and things that both consumers and businesses are interested in. We do the work to remove the seasonality, remove the noise, so we can see the underlying trends in these activities. And it tells a very interesting story, especially when you look at the arc of something like home furnishings, which was really dented by some of the early stage tariffs. A lot of that is imported furniture, and there was some confusion and some price increases on the part of in that sector that deterred customers for a while, but we're beginning to see that recover. You can see home financing in light blue. That has been the refinancing driven surge, but also those original, first mortgage loans based on lower rates that we've seen come through. And what you're seeing overall is the charts are beginning to sort of roll over. We're seeing the pace of growth in search interest level off a little bit, but these are still indicative of search interest that's growing at a pretty good clip. So we expect actual growth, not just, we don't expect this activity to necessarily level off in terms of, start slowing, but we do think that the pace of growth may taper off for a little bit. And that has led into some of our forecasts for sales that we do expect some weakness early in 2020 as we move through the first quarter relative to the high pace of growth that we've seen lately.
All right. Fantastic. Peter Forbes, really great stuff. You guys do awesome research, tons of charts. Love the quantitative take here. Peter, thank you, sir.
Thank you,
Mr. Forbes,
very much for having us on.
You got it. Mr. Forbes is a data scientist at Orbit Research.